This program is made possible by the New York law firm of Zalman and Storman, who specialize in the field of personal injury law. Welcome to Lawline with your host, Alan Schnorman. Mr. Schnorman is a distinguished trial attorney, author, and lecturer. Each week, Lawline will bring you the most knowledgeable experts in the field of law today. And now we introduce our guest and our host, Alan Schnorman.
Welcome to Lawline. The new tax law, which has been heralded as a tax on the wealthy, may have a few surprises for other economic groups. Today we'll look at some of the changes in the new tax law and see who the winners are and who the losers are. Our guests are Alan Rosenblum, a tax attorney and partner in the law firm of Rubin, Baum, Levin, Constant, and Friedman. And also we have Jerry Lerman, a tax accountant and partner in the accounting firm of Goldstein, Golub, Kessler & Company. Hello, Alan. Hello, Jerry.
Hello, Alan.
So, Alan, tell us from a legal stand of view, what is this new law about? I mean, who really wins, who loses?
Well, I'd have to say high-income earners are the real losers in this new tax bill because the rates have jumped significantly from 31% as much federal as 39.6%. And for those people who are living here in New York City, the effective rate on income can be as high as 55%.
Why is that? Because of...
It's the combination of the federal, state, city, and contributions made to Social Security.
Is there any surtax on high income earners?
Well, if you read the law, it's a 36% rate if you earn up to $250,000.
Taxable income.
Right. Thereafter, there's a 10% surcharge, which would increase that 36% rate to 39.6% rate.
Jerry, what about the middle class? Does it affect the middle class?
Well, the middle class is defined how, Alan?
Most working people, I guess.
Most working people are in the middle class, and many people, who, particularly those who live in New York, are affected by it. Rates jump rather rapidly, and it doesn't take long to get up to a 36% tax bracket.
Well, the law also increases fuel taxes. There's some increase in gasoline taxes and the like. So I think the overall effect of this would be to increase someone's tax burden, whether directly or indirectly.
Now, this applies right back to January 1st, 1993, isn't
That's
that correct?
correct. However, you should note that any increase in tax liability attributable to the increase in rates can be paid over 3 years, 93 a third, 4 a third, and 95 a third without penalties or interest.
Actually, that's 94, 5, and 6.
So it's sort of
Whatever,
like,
94,
sort of like
5,
a
and 6.
loan
Right.
That's
that the
right.
government is
It's an
giving you.
But Congress, in its infinite wisdom, did it again to themselves, because here you're forcing taxpayers, one, to quantify how much this tax law just cost them, and two, to face that increase every year for the next 3 years. 94, 95, and 96, because they're paying a third of the increase each of those years. 96 is an election year again. So when you sit down to do your tax return in 1996, and 1995 return for 1996, you'll be facing the exact amount of this tax increase.
Alan, give me a legal opinion. In 1986, they lowered our rates, they took away the deduction, and they said that was going to be the tax savings. Now they're increasing the rates again.
Well, what has happened is that they're increasing the rates while not giving you back your tax deductions. So what they have done is taken away whatever deductions you've had, let's say from passive investments, real estate and the like, and they've increased your rates now. So it's a pretty heavy tax burden that we're looking at, especially for people who are high-income earners.
Well, let's talk about it. You mentioned real estate passive tax losses. Now, I know prior to 1986, if a person, whether they were middle class, whether they were high earner, let's assume they had a condominium as an investment.
Mm-hmm.
Now, I remember back in those days in 86, you used to open the New York Times real estate section and see buy a condominium and get tax losses against your income and 50% losses, and even though you might have been losing money on the actual project or the condominium in Queens, you actually had a bottom line where you made money because of taxes.
Well, in most cases, Alan, you weren't really losing money because the shelter that was thrown off from depreciation, which was not an economic deduction,
Right.
was not something that you paid for other than over a period of years, that's what was creating the loss on the transaction. What the 86 Act did was it stopped people from taking losses that were passive. That is, that in businesses in which they were not actively involved.
Okay, now they've reinstituted
Correct.
partially or something
Well-
the real estate tax losses. Can you tell us about it?
Well, they've reinstituted it for people who are in the business of renting, operating, building, or managing real estate. Those who are passive investors who go into a deal are unaffected by this change. And basically what
They still don't get that deduction.
They still don't get it. What the change does is to permit people who are truly in the real estate business to take losses from their real estate business and use it against any other type of income they have. It does not...
Any other dividends?
That's correct.
All other
or
income.
all other income. It does not affect people who casually invest in real estate or people who invest in real estate but are not involved in it up to a significant time.
Jerry, give us some definitions.
Definitions.
What is the definition of a person who's involved in real estate, as Alan says?
Well, for purposes of this provision, you must spend more...
Listen closely.
You must spend more than 50% of your time in services doing these real estate operations.
All right, let's take that
Okay.
first. More than 50% of your time. So in other words, let's take a lawyer. And we have a few lawyers here. A lawyer who invests in real estate. He would have to put down 50% of his working time
That's correct.
into real estate.
To his active management of the real estate.
If somebody was semi-retired, it would be 50% of his working time. Would that be fair?
I would think so, yes. I
Okay,
would
so if
think
he
that would be
devoted
fair.
2 days a week to work, at least 1 day a week would have to be to...
However, that's correct. However, the second rule, the second part of
I
that
stopped
rule
you on that.
is an and. Not only must you spend more than 50% of your time doing real estate type activities, you must also spend more than 750 hours a year doing the real estate activities.
15
More
hours
than-
a week.
That's correct.
Right.
Well, it's a little less than 15 hours a week.
Approximately.
It's a significant burden
Yes.
to meet. And basically, it was meant to help people who are, I think for the most part, in the real estate business full-time.
So, Alan, if somebody is watching out there and they own a condo here and a condo there, and they say they comply with the law, how should they prove this compliance? What's your recommendation to them to prove this compliance?
Well, I think as with any of the rules that were instituted in 1986 that deal with time spent doing an activity, you should maintain a log. You should maintain a calendar and indicate in the calendar on a contemporaneous basis the hours that you're spending doing these real estate activities. That's the starting point.
If somebody's looking at real estate to buy, would that be part of this acquisition time?
I would think if you were already involved in the real estate business, yes. However, if you're first going into real estate, I would think not.
Okay, let's continue with just on this vein, although I know a lot of people it doesn't apply to. Let's assume between 1986 and 1993, a person was not able to take any tax losses from real estate, but I know you were able to accumulate these tax losses against any potential gain. Not too many gains around anymore, but any potential gain. What happens to all these losses between 1986 and today?
Well, they're suspended losses. They continue to be suspended losses because they are considered, if you read the law, former passive losses, which can only be used, even though there's a change in the law now, can only be used against income from the activity they came from, including a sale of a real estate.
So they're going to be held in limbo
In suspense.
They continue to be held in limbo.
until there's a profit
That's correct.
or
gain
or
from
a
the sale
disposition.
of the property.
That's correct. So a disposition, in other words, if you have a series of losses that, if you've made the proper elections to treat losses with respect to a particular piece of property, and those losses have carried forward because they were suspended, when you sell the property, the law
Then you can
says
take it.
that's an
They trigger.
economic triggering of the event, and therefore you get to claim your loss.
Got it. What about capital gains? Have capital gains been changed?
No, capital gains remain at a maximum of 28%.
Oh, so in other words, those are less. So for a high
Dramatically less.
a high income earner, now capital gains would be at a less rate. Alan, you want to say?
I was just going to say that as a result of the change in rates as it applies to ordinary income, which would be salary, dividends, interest, and the like, and the lesser rate without a surcharge on it of 28% on capital gains, the premium now is to go back to what people were doing in the 70s, in effect, before you had an evening out, to try to get transactions characterized as capital gain as opposed to ordinary income. Now,
Before we go any further, now that's a tax savings.
Right.
If we got a tax savings, now tell us what a capital gain is.
capital gain is a gain derived from the sale or exchange of a capital asset.
Stocks, bonds.
Right.
Traditionally.
What about a house?
House is a capital asset.
That's correct.
Yes,
Okay.
it is. So if you sold a home at a gain, that would be a capital gain. Of course, we know that if we sell your own residence at a loss, you can't take the loss.
I didn't know that.
Yes.
Only if there's a gain, Uncle Sam shares in
Yes.
that, but
Unless-
not and there's a loss.
That's right.
Interesting.
Unless you were holding the property for investment purposes.
And typically you're not.
That's right.
Unless it was a two-family house in Glen Cove, Long Island. Or something.
I want to point out that they enacted a companion statute to the capital gains 28% provision to, in effect, prevent conversion of
Don't give me highly technical
I
words.
won't. Ordinary income into capital gain. I'll give you one example. You buy a stock
Right?
for $100, and you agree next year to sell me that stock at $107.
Next year meaning more than 1 year
Right.
from the day you bought it.
Okay.
Ordinarily, you have sold a capital asset, the stock, for a $7 profit,
Right.
against which you have a 28% capital gains tax.
Right.
The law says that's a conversion transaction because it's analogous to a lending transaction.
Because it was done simultaneously with the
And
purchase.
besides that, you're getting an interest rate of return as opposed to a full upside potential. There are many other types of transactions.
But if I buy a stock today, I have to hold it how long?
1 year, more than 1
1
year.
year.
More than 1 year.
If I hold it 1 year, I then pay the 28%
That's
rate.
correct.
Okay, but what? Tell me, how much does a person have to earn until the taxes are more than 28%? Approximately.
I don't remember the bracket.
What do you mean more than 28%?
In other words, if I'm a wage earner, I earn $25,000 a year, my wife earns $25,000 a year, does that put me in the 28%?
No, that
bracket?
would be, I think the maximum then would be 26%.
Okay, so
yes.
that really, capital gains would not apply to
I think
me.
about $170,000.
All right, so we're really talking about substantial individuals.
Right.
Mm-hmm.
So this is really geared, outside maybe of the gas tax
Right.
on gasoline, which affects everybody who drives.
That's correct.
And of course, that's going to be converted into other consumer items, anything that's trucked. But it's really a tax for the wealthy.
Well, it's one could say it's a tax basically to give incentive to the wealthy to invest with the view to capital appreciation in the future.
Jerry, let's talk about tax savings. Everybody wants to know now, tell me how I'm going to save on these huge taxes. How do you do it?
Well, firstly, you have to plan your tax position from year to year. One of the other changes that took place with this act was a change in the alternative minimum tax. The alternative minimum tax is a secondary computation. You go through your regular tax computation, you then must compute your tax on an alternative basis.
So are you saying, what are you saying to save taxes now?
Well, I'm saying that in order to save taxes, you have to know what your tax liability is going to be before you do anything else. Meaning plan.
Otherwise you can't, what about...
For example,
Wait, before you go into that, what
Yeah.
about triple tax exempt municipal bonds?
perfect.
Are those subject to this alternative minimum tax?
Depends on how the bonds are issued. If they're for private activities, the answer is they may be subject to the alternative minimum
Such
tax.
as maybe an industrial bond or something
That's
like
correct.
that.
That's
Another
correct.
simple
Alan?
example is try to get deferral of income into the future now because rates are high. One simple thing people can do, if it makes sense as an investment, is buy E-bonds. you can accrue interest on an E-bond without picking up that income currently.
So you pick up the interest.
When you cash it in, and if you cash it in, you can even roll it over into H-bonds or double H-bonds and postpone the realization of all that interest income into the future.
We have to take a break now, but right after the break, I'm going to ask both of you, how can we defer income? What other measures, whether it's IRAs, KIOs, or these HR-10s, whatever they are, and maybe even variable annuities. We have a lot to discuss. You're watching Lawline. I'm Alan Schnorman, your host. Stick with us.
After dating the guy forever, you think I could tell him anything. Why is this so hard? I'm really scared.
It takes a lot of guts to tell someone he's too drunk to drive. But you can do it. Just say it. Because if you don't, there may be nothing left to say.
Kevin, I'm gonna drive.
Take the keys, call a cab, take a stand. Friends don't let friends drive drunk.
When your employees train with the National Guard and Reserve, they learn to be better team players, better decision makers, and better leaders. It's training that makes them better at serving our country. And better when they come back to work for you.
Bill's back.
Be a hero. Give your employees the freedom to protect ours.
Hello, you're watching Lawline. I'm Alan Schnorman, your host. Today we're talking about the new tax law and how you can save taxes. With us are our guests Alan Rosenblum, a tax attorney, and Jerry Lerman, a tax accountant. Now, right before the break, I asked both of you how we can defer taxes on interest and dividends, and I mentioned a few things. I'd like to cover them. What about variable annuities? How does that affect the
Variable
taxpayer?
annuities, Alan, are a method by which you have a buildup in income, but it's not taxed currently.
Sounds
it's an
good to me.
insurance product. One of the few tax shelters remaining are two. One are qualified retirement plans, pension, profit sharing, KIO, 401k. And the second are insurance products, life insurance, variable annuities, those kinds of products in which the income is built up but not taxed to you during the build-up period, taxed to you at the end when you cash it in.
Here we have a law change. Prior to this new bill, the amount of compensation that was covered for purposes of qualified pension plans, 401 plans, was $200,000. And that produced a contribution of approximately $30,000.
You mean the maximum that
Right.
somebody could contribute
That has
under
been
401?
reduced- That's right. That has been reduced to $150,000 covered compensation, which now I believe that the contribution is around $22,000 or maybe a little less than that.
Well, let's stop
so
for a
it
second.
affected the amount you could put
Alan,
away.
let's talk about terms that I can understand. If I can understand it, the public can understand it. If I'm a high wage earner and I got my own business and I want to start this, what do you call it, 401k?
Or KIO plan.
Let's take the 401k. All right, for myself and my employees, what's the maximum I can defer?
The maximum you can defer under a 401k plan changes annually. This year, I think it's about $8,900.
89. Now,
Now,
do I
we
also
stop
get
you
the
for-
deduction?
Yes.
So in other words,
It's
I
not
reduce.
taxed income currently.
That's good.
Non-taxed income. However, this is one of those areas of the law that you can't just make a blanket statement and say that's the number. There are comparability problems. If you have employees, you've got to cover a certain number of employees, and you have to cover them with a certain amount of 401k benefits. So if you're the owner, you may not be able to contribute $8,900 unless everybody under
Is
you is
getting
contributing.
that-
Let's go
type
into
of
that now.
portion
We're
of
talking about the
benefit.
life insurance
Right.
products to save money. Now, we mentioned variable annuities. If I put in, let's assume, $50,000 into a variable annuity, and I have a plan where I contribute $1,000 a month,
Right.
does that mean all the money that I contribute to this variable annuity that throws off dividends and interest will not be taxable to me until I take it out?
Until you take it out. Now, if you remember, last year they were thinking about changing that law.
Right.
although it never passed. But right
Insurance is
now,
a very strong
right,
lobby.
right now, yes, you defer all of that income until you start to take it out, and when you take it out, you will be able to recoup as part of your basis what you put in, and part will be taxable.
Now, I know you can't take it out until 59 and a half or something
Right.
of that nature, but why is this done by life insurance? That's what I don't understand. Why can't you open a variable annuity contract with Merrill Lynch?
Well, it has to be done in the context of a guaranteed annuity given by an institution that's in the
commercial,
business
right.
of writing on insurance or on people's lives. That's what the
You
law
and I
is.
couldn't enter into that kind of agreement.
Can't
Alan.
be done privately, and
Right.
Merrill Lynch would be considered to be done privately. It has to be a licensed insurance company.
Okay. Now, I've just learned about irrevocable life insurance trusts. Now, is it true that if a person who's a high-income earner sets up an irrevocable life insurance trust, that all the monies that are paid into the trust can be passed tax-free to their children?
The answer is generally yes. It's important now for another reason. As income tax rates have gone up, estate tax rates have gone up. And for estates in excess of $3 million, the rate now is 55%. And if you're really talking about very rich people, when you get between $10 million to $21 million of an estate, big hitters, the marginal rates phase out, the lower rates phase out, and everything is at 55%.
And add to that New York State.
Add to that New York State, so you may even be
Yeah,
about
over
60. What a life insurance trust, as you call irrevocable life insurance trust, does is to, in effect, buy life insurance on a beneficiary who doesn't own the life insurance, the trust does.
Right.
When that beneficiary dies, the trust receives the proceeds of the policies, and if it's properly planned and constructed, that life insurance will not be included in the estate of that beneficiary.
I understand. From what I understand of the trust is that the widow, let's assume I get it for myself and I live to 70 years old and I pass away, that the money will go into a life insurance trust, that my widow can have the interest from that trust should she desire it, and if she really needs the principal, then the other trustee can give it to her for her welfare.
That's correct.
Or something of that nature. Hopefully she wouldn't. And then when my wife passes away, that actually will go to the children totally estate tax free.
That's correct.
I mean, that sounds like a good tax savings.
Right.
I
Well,
mean,
that's one of the tools in our bag of tricks that we certainly use for.
Let me ask you this,
wealthy
Jerry.
individuals.
This is shown in the metropolitan New York area. New York City is the highest taxed city, certainly probably in the country. Now, if not the world. If somebody moves outside of New York City, let's assume they move to Long Island, how much do they save on a tax from being a citizen of New York City to becoming a commuter to New York City?
Well, the difference in rates is dramatic, Alan. The New York City rate is 4.3 or 4.4% on all your income.
Right.
The commuter tax rate is less than 1/2% on your New York City earned income.
So if I move from Manhattan to Roslyn, Long Island, how much do I save on my taxes?
Net of federal tax benefit, probably something around 3% or a little less.
Just by moving to Long Island?
That's correct.
What if
but,
I move?
But
Yes.
have you given up your home in New York City?
That's the question.
Because if you haven't, you're into a whole other issue.
You
And
can
then-
even do better. You can move to Florida and eliminate at least any state or local income tax.
Let's discuss that. I'm working in New York City. However, what I do is I fly down to Florida. I stay in a hotel here during the week or whatever I need to work here, and I fly down to Florida. What happens?
Well, we are assuming you have no place of abode in New York City.
Okay.
None whatsoever.
Right? But I do business here.
You can
Yes,
do
you can
business
do
here.
business here.
If you have no place of abode here and your domicile is in Florida and it's your principal residence,
right.
you're fine.
What happens? In other words, what taxes do I save?
Well, you will pay income tax to New York on monies earned while working here.
New York
Right.
State and New York City.
New York State and New York City.
Fine.
However, you will not pay any state tax on your outside income,
Dividends, interest, bonds.
capital gains,
Capital gains,
whatever.
right.
Significant savings.
Right.
And Florida doesn't have a tax on these?
No, it has no income tax. It has a very, very small, in fractions, intangible tax.
Is that why on Thursdays and Fridays the planes are full of people going from New York
Now,
City to Florida?
I want to point out that if you maintain a home in New York,
An apartment.
An apartment, or
any residence.
any place of abode, you begin to get into questions of, one, are you domiciled in New York or continue to be domiciled in New York? And if you're not, are you here more than 183 days a year?
You're saying you have to live by your mother's house.
That's right. You have to live by your mother's house or rent a hotel room.
Alan, I must tell you and the audience watching this program that New York State and New York City are aggressively seeking out people who claim not to be here.
What happens if I move to New Jersey, I move to Connecticut, I move to Pennsylvania? What kind of tax saving is that?
I don't believe Connecticut is much of a savings now.
And New Jersey rate is almost equal to the New York State rate. Your saving would be on the New York City portion. I don't remember what the Pennsylvania rate.
Know.
And it's too far to commute anyway.
Any other ways that you can save on your taxes?
Well, there are two provisions, just to point out, in the tax law. When they increased rates and they limited the amount of capital gains, they put in two provisions. To whatever extent they'll be helpful, I don't know. It's the ability to sell publicly held securities and reinvest it in companies that are small business investment companies licensed by...
Talk to me in terms that I can understand.
Okay. The law permits you up to $50,000 of gain per year.
Right, in?
$500,000 per lifetime, to sell stocks that are publicly traded.
Right.
And reinvest them in companies that are licensed as small business investment companies by the Small Business Administration.
Are these publicly traded companies?
No, they're not. You have to look
and
for
where's
these
the tax
types.
savings?
The tax savings is that $50,000 of any gain on the sale of your stock, publicly traded stock, does not have to be reported.
Now, that's very interesting.
Yeah.
How can we save taxes in the moment we have left?
In the moment,
What's your advice to the public, the tax-paying public?
plan your 1993, 1994 situation and take advantage of deductions.
Alan?
I'd say plan ahead and try to match gains with losses, see if accelerating income or deferring deductions or vice versa will help you, and I think consult a professional.
Yes.
Most people would pay hundreds of dollars an hour for the information that you just got. You're watching Lawline. I'm Alan Schnorman, and thank you for watching Lawline.
You have been watching Lawline with your host, New York trial attorney Alan Schnorman. Mr. Schnorman will be back with you next week at the same time. If you have any questions about this week's program, please write to Lawline, 63 Wall Street, New York, New York, 10005, or call area code 212-432-9111. This program is made possible by the New York law firm of Zollman and Schnorman, who specialize in the field of personal injury law, located at 63 Wall Street in New York City.